Hey, what's going on, guys? Welcome to another YouTube video, and I'm so happy you guys are here because today we're going to be talking about a company with a ton of potential, and I'm going to be even sharing with you why I think that this stock has immense growth potential in the next 3 to 5 years, and actually even sooner, because I'm going to show you a piece of evidence that I think will hold true as it did with another similar company. Again, you'll get to find that out. Stick around because I got a lot of things to show you. I'll try to keep it as condensed as possible for you guys so you guys get the most amount of value in the least amount of time. Hopefully you guys enjoy. If you don't mind, smash the like button for the YouTube algorithm, and don't forget to subscribe if you haven't subscribed already. Without further ado, let's talk about Upwork. All right, so let's dive into Upwork here. So I'm gonna be looking down so I can see my monitor here, but you guys are gonna see everything on the screen. So Upwork, right? Very similar to Fiverr. And we'll talk about Fiverr and their connection and what I think is possible for Upwork in relation to Fiverr a little bit down the road. So Upwork, here is a stock that is sitting at $52. And from its IPO of back in 2018 of $20.99, since then it has climbed over 151% to a total of $52 per share. So we're talking from $20 to $50. And if we're looking just at the 1 year time span, it has dropped all the way to $9 from that IPO and has climbed over 400%. So if you bought any shares just a year back, you would be up over 470%. Pretty crazy. This is great to see. I honestly have been buying Upwork very recently in the 10, 15, 20, and even $25 range. And I'm okay with buying Upwork, and here is why. Upwork executive summary, we have their earnings are forecast to grow 65% per year. So they have a very bright future. They have a stable share price. Upwork is not significantly more volatile than the rest of US stocks over the past 3 months, typically moving, up or down 9% a week, which I think it is kind of volatile, especially more recently, but it's doing really well in the sense that it's going up versus down. So that's good. Upwork's weekly volatility, 9%, has been stable over the past year. So they're saying it's on average either going up or down 9% every year, which is, fairly common for stocks of this growth. Obviously, it's saying it's 1,300% overvalued. 56 is their current price, but their price to book ratio is, should be around $3.77. So it's saying way overvalued of a stock, right? Even though the growth potential is 56%, but it's just saying at this valuation, it shouldn't be worth that. But look at the earnings and revenue growth forecast, because right now the reason why I think they're saying that is because, right now it's negative, right? Their earnings have been negative. They haven't been making net money. Yeah, sure, their revenue has been increasing. But what good is a company if they can't be profitable, right? That's what Wall Street always likes to think about. And, it's a good way to think, mostly when you're talking about companies that aren't growth stocks, because growth stocks don't really care about profitability, right? As long as they have positive cash flow and they're, at least, paying back their investors and they have great revenue, but they don't need to be necessarily net income. They don't need to be profitable in the sense that they're making so much money that they know what to do with, because those are only a select few of companies that are doing that right now. Obviously, the tech giants, right? The Apple, the Amazon, the Tesla this year, and a few others like Google, Microsoft, they're doing well, right? But they have a lot of growth still ahead of them versus behind them. They need to be borrowing money, and they need to be increasing their revenue, and they need to be expanding. And that doesn't necessarily always, fare well with Wall Street, right? Wall Street always likes to see that net profit come in. So that's what we're looking at here. So by 2023 and end of 2023, somewhere in there, they're saying that there's going to be a slight chance of profitability. I can see profitability at the end of 2021, if not the beginning of 2022. That's my personal belief. But we'll see how close this is to analysts or versus my own personal belief. And I'll show you exactly kind of why I think they're going to get there in just a second. But look at their balance sheet. This is their balance sheet. And no, it's not cut off right here. This is actually their debt. This is how little their debt is. This is 12.6 million. Look, they have that in equity times 15. They have other liabilities here. They have accounts payable. Their cash and short-term investments, they could take a tenth of that and pay off the debt. That's what I'm saying. They're so debt-free that it's ridiculous, especially for a growth stock. Long-term and other assets, they have 258 million. Physical assets receivable. So here's a good example of their balance sheet if you guys want to take a look at that. But again, that debt bubble is so tiny. There's nothing there. Upwork, let's look at their financials. So here's what I wanted to talk about, right? We obviously saw that the revenue increase. We saw from 164 million in 2016 to 200 million the following year, 253 million the year after that, and then 2019 we had 300 million. And we can take a look at their quarterly, which if you add up Q1, Q2, Q3, we don't have Q4 yet, but if we add those up, we are looking at 80 million, 87, and 96. So we're looking at near $350 million. And I think with the pandemic, we might even see $400 million for Upwork in 2020. It'll be very, very tight there, but that would show an increase of over 25% in year-over-year revenue, which is actually really good. We haven't seen that since 2017 to 2018 levels of 25%. And we might see our first profitable quarter in Q4, or at least in Q1 of 2021. Look at this net income here. It's gone up and up and up. And here we only had negative 2.75 million in that quarter versus like Q4 of 2019 of 7 million, or Q1 of 2020, which was 10 million. So when you look at these net incomes that have been, close to two-figure, $1 million range, we have a quarter where it was, less than 3 million. And then we might have a quarter of possibly, less than 1 million, or even at least positive, a few 100,000. That would be incredible for, Upwork's valuation. Obviously, then Wall Street might start taking them a little bit more seriously. But let's look at Fiverr, because Fiverr has been on an insane rally, right? When you look at Fiverr's annual year-over-year revenue, this company is sitting at a $10 billion valuation. So near double, almost 11 billion, near double of what Upwork is doing, but yet they're only bringing in $107 million in revenue, and they're losing $33 million in net income, at least 2019. But I guarantee that in 2020, they will still be unprofitable or close to profitability, but nowhere near Upwork's 300 million, if not 400 million revenue numbers. So that's really fascinating to me, because look, when you talk about Fiverr, their stock price has gone up 1,000%. Their valuation is sitting at $10 billion. Meanwhile, Upwork, it has only gone up 470%. So they could still double percentage-wise from Fiverr's valuation and still be outperforming them as far as revenue goes by 3 to 4x per year. So there you have some good analysis reads there. Obviously, I didn't get super technical with you guys. I just want to give you kind of the lay of the land of their competition and their overall potential in the next 3 to 5 years, because that's really, really important. And honestly, I like Upwork. Around $40 per share if you can buy it down there again. If we see a nice dip in the stock, of course, I would personally be buying. Anywhere under 40, I think, is great. 36 would be cool. 35 would be great. Obviously, 20 would be hard to reach, but if it gets down there, I'll be buying, heavy. I'll start taking nibbles around 40, and then I'll start buying heavier around 35 or below that. But if we don't see that, I'm totally fine, because I personally see the stock going to a couple $100 very, very shortly. So if we don't see a huge dip, not a problem. If we do see a huge dip, great, a better buying opportunity. Because honestly, if we get anywhere close Fiverr's valuation, that would already be a 2x. And because they're, bringing in more money by 3, 4x than Fiverr, I could definitely see, a 4x in the stock as well. All right, so I hope you guys enjoyed this video. If you did, don't forget to smash the like button. And also, if it's your first time to the channel, don't forget to subscribe. Hopefully I brought you guys a lot of value. If there's something you'd like to see in a future episode, leave it down in the comment section below. Without further ado, I'll see you guys next time. Peace out. Feel free to check out the links down in the description below, where you can get a free stock from Robinhood, $20 free from Stash, 2 or more stocks free from Webull, or $10 free from M1 Finance.